Hey, what's up guys? Welcome back to another video. My name is Lion, and in this series, I challenge myself to learn a brand new skill every single week. Now, with the whole pandemic going on right now, I decided to learn something that's going to be actually very, very useful to me and to you during this whole time of pandemic and uncertainty. I decided to learn about the stock market and how to invest in stocks. So I spent the past week just learning everything I can about the stock market, how to invest in stocks, what I need to do, and all the basic steps that I need to take in order to be able to invest in stocks the right way. So this video is going to be a very simple and very basic introduction on how to get started with stocks. Now, before we get started, just one thing I wanted to tell you guys. I am from Montreal, Canada. So for the most part, all the steps that I'm going to be talking about is really relevant to anybody all around the world. But a couple of things, especially the accounts that you try to open, they're more relevant to Canada, but I'm sure there are equivalents in other countries wherever you're from. All right, so let's get started. So number one, the first thing that you should consider doing before even considering putting a single dime into the stocks is opening the proper accounts. Now, if you're investing in the stock market, you want to make more money. You want to invest your money, and obviously you want your money to grow and make you more money down the road. Now, all that money that you're going to be making is going to be obviously considered as an income. It's the same income as if you're working a job and you're making money. And what happens to every income that we make? We pay taxes off of it. The government wants their cut. However, there are good news when it comes to stocks because there are legal ways to really avoid paying money and really just throwing away your money back to the government. So in order for you to do that, you need to consider opening one of two accounts. So in Canada, there are basically two accounts that allow you to really invest your money without paying any taxes of any income that you make off of your investment. The first account that I want to talk to you about is a TFSA. A TFSA basically stands for a tax-free savings account. And that account was created basically by the Canadian government a few years ago, and it's made just for that, for you to basically be able to save your money without you having to pay the government income tax off of whatever you make on this account. So a TFSA is basically a tax shielded account, which means that any interest, so let's say if you open a TFSA and you put it into, a basic savings account with an interest rate, all that interest is not going to be taxed at the end of the year. So that's a very, very good thing. The same goes when it comes to stock investing. So if you're opening a TFSA and you invest the money off of your TFSA into the stock market, whatever profits you're going to make off of that account, and if it stays in that account, you're not going to pay any income taxes off of that. Now, the best thing and the reason why a TFSA should really be your best friend when it comes to investing your money is that a TFSA is an account that you can very easily take money off of and put back in. So it's just like a regular savings account. So if you want to buy a pizza, you want to buy a car, you want to buy a house, and you need money to do that, and you don't have any money in your regular checking account, you can just very simply go and take that money off of your TFSA, off of your tax-free savings account, and use that to buy whatever it is that you need to do without ever having to pay an income tax off of that money that you have in that account. And another great thing about that account is you can also put money back into that account and continue investing. So the second account that you can use in order to invest in stocks is an RRSP. An RRSP is a registered retirement savings plan. And although you can invest in stocks just like you would invest with a TFSA, the main difference between a TFSA and an RRSP is just that. It's a retirement plan. So basically the money that you're putting in there, you should consider only using it when you retire or when you really, really need that money and don't have any money anywhere else in other accounts. The main reason for that is an RRSP, just like a TFSA, is shielded from taxes, but in a very different way. While the TFSA is shielded from taxes or any interest or any profit that you make within that account, an RRSP is shielded from taxes in the way that you don't pay the tax in the first place. So let's say you're working a regular job, right? You're working a 9 to 5, 40 hours a week. If you want to put money into your RRSP, you're shielded from paying the tax initially. So normally when you would work and get a paycheck, that paycheck that you get at the end of the week or at the end of 2 weeks, the deduction of taxes that's going to the government has already been made on that check. So you get a check after you have already paid the tax to the government. Now, when you're putting the money into an RRSP, you're basically avoiding paying that tax right now. So you're not paying that tax right off the bat. You're putting that money before taxes into an RRSP. And the idea is that once you decide to take that money out, so let's say when you reach the age of 65 or whatever age that you decide to retire at, and you decide to take that money out, you're going to be paying the taxes off of it. Now, the whole idea behind this thing is that you're going to be at a lower tax bracket when you decide to take that money out of your account versus when you're putting that money in and you're saving on that difference of tax brackets between the time when you put in the money and you're making a higher salary to the time when you retire, your salary lowers. And at that point, when you take that money out, you're paying a lower bracket, you're paying less taxes at that point. So an RRSP is also a great account in order to basically invest in stocks and really wait for them to accrue interest and profits over time and really get all that money when you retire. So I'll let you research a little bit more about these accounts, but I really recommend you really open both of them. So you can pretty much open these two different accounts pretty much anywhere, at any bank or at any online broker. And believe it or not, when you decide to buy stocks, it's not free. You have to pay per transaction. So every time you buy a stock in the stock market, you have to actually pay a fee to whatever brokerage firm or whatever financial institutions you're dealing with. So specifically the one I chose and I've been working with for the past week is called Questrade. And I'm going to put a link to them down below. I'm not affiliated to them. I'm not getting any commission off of that. But I just think it's the best brokerage firm in Canada that you can use in order to invest in stocks. I think that the fees are the lowest. So there's basically two main types of different stocks that you can invest in, and I'm going to briefly discuss the differences between them. So basically, the first stock that you want to be looking at is growth stocks. Now, growth stocks are basically just that. You are buying a stock at a certain price, or let's say you're buying it for $10. And basically what you're betting on and what you're hoping that will happen is that that stock will grow up in price. And that's basically what you want to do. You want to buy a stock at a lower cost and then selling it at a higher cost, and that's how you make profit. Now, the second type of stock that you should be looking at is dividend stocks. Now, dividend stocks are a little bit different than growth stocks because they're usually big corporations such as big financial institutions and some blue chip companies that instead of really growing, because there's such huge established companies. So if you, for example, you're looking at a Canadian bank, one of the major Canadian banks, right? They've been in business for hundreds of years most of the time. And their stock is pretty much stable. So they don't go really up, they don't really go down. They're more or less very stable. If you're buying that stock, you're really not hoping or you're not betting really on that stock really jumping up and really making you money by increasing its value, because that's really not going to happen that often. I mean, obviously stocks go up over time, but it's really not going to make you that much money on the actual growth of the stock. So what these companies do, so what these banks and other major corporations like that do, in order for you to put money into their stock, they're paid dividends. Basically an amount of money that all these major corporations allocate in order to pay their shareholders either yearly or quarterly or monthly or whatever it is for the value of the stock. So you're not hoping that if you're buying it for $1,000 that it's going to be $2,000 in 2 years or 5 years or 10 years from now, but you're hoping to receive these dividends. Now, when should you buy dividend stocks? When should you buy growth stocks? Now, for the most part, I would really recommend to have a little bit of both and really diversify a little bit and buy a little bit of dividend stocks, a little bit of growth stocks, and just create a portfolio. But for the most part, if you are a younger individual, so if let's say if you're in your 20s or in your 30s and you're considering to start investing in the stock market, I think that it's a better strategy to really put more of your money into growth stocks because you have the time until retirement. You have time and you still are in your prime age to really be working right now and putting money on the side in order to invest in stocks. And really you won't need them until later on when your income decreases. So you can take the chance to really invest more in growth stocks, which are more volatile and go up and down. But if you wait them out over time, I think that your returns are going to be a lot higher than investing in dividend stocks. Now, dividend stocks, on the other hand, are very good for somebody who is really approaching the age of retirement and just does not want to take any more risk with their money that they invested, because they don't have, they might be losing, if they're retiring very soon, they might be losing that steady income from their jobs. And they want something that's guaranteed, that's going to be there no matter what. And that's where dividend stocks really come in handy, because you're still investing your money, you're still making more money every month, but your investment is guaranteed. Like the principal that you have is going to be there for you when you need it the most. All right, so now that we discussed the main difference between the two basic kinds of stocks out there for you, I think the question that I was asking myself and the question you will be asking yourself, which specific stock should I be buying? And that's a question that really nobody can answer you directly. That's a question that I think that you should really do your research. There's a whole bunch of YouTube channels out there that really go in very detail and specifics on which stocks you should be buying at which point in time. And I think that overall you should really try to get into it, do a little bit more research, and really decide which stocks work for you. As a Canadian myself, another question that you should be asking yourself is whether or not you should be buying Canadian stocks or you should be buying US stocks. Now, there are different segments when it comes to stocks. So you can be buying stocks in tech companies or in oil companies or in real estate companies, and there's a whole bunch of different options out there. And when it comes to US stocks, there are definitely a lot more options when it comes to different types of stocks than it is with Canadian stocks. And if you want to invest in companies that everybody's talking about, like Amazon and Facebook and Google and Uber and all these companies, Tesla, they're obviously all US stocks that are trading in US dollars. So you also have to take into consideration the exchange rate at the time where you'll be buying the stock versus the time where you'll be selling the stock. The most important thing when it comes to investing in stocks is don't invest in companies based on what's happening with them today or tomorrow or yesterday. Choose to invest in companies that you personally really believe are going to thrive in the next year, 5 years, and 10 years. Really look into companies that you think today are doing great and are going to be doing even better in the future. So, and this way you cannot go wrong. This is basically a strategy that I've learned from Warren Buffett. He really doesn't concern himself on what's going on with any certain company on a daily basis. That's way too much work, and it really makes no difference at the end of the day, because if you're deciding to invest your money, the way you should be investing it is long term. And in order to do that, really look at the history of the company. Look at where the company has been, look at where they are today, and make your own predictions and do some research. Where do you think this company is going to be in the future? So if overall you believe the company is going to be growing and doing better and better things, this is a great indication that that's a good bet and that's a company that you should be investing your money in. If a company is really iffy and one day the stock is going up and another day the stock is going down, that's going to be way too risky for a beginner investor such as yourself. And also it's going to be something that's going to require a lot of work, because you're going to have to keep an eye on that investment on a daily basis to see what's going on with the stock. Now, I want to invest in stocks in a way that that's going to be a passive income. I don't want to day trade. I don't want to sit on the computer all day and look at stocks and buy stocks and sell stocks the same day. My whole idea behind investing my money into the stock market is really to create a passive stream of income. In order to do that, I really want to be hands-off as much as possible. I want to buy the stock on day one and then cash out on that stock 5 years from now or 10 years from now when it made me a lot of money. I don't want to follow stocks every day and see what's going on with the company on a daily basis. Another thing I want to talk to you about really quickly is a lot of people are talking about diversifying your portfolio. And I'm sure you heard that term before. And basically what that means is that don't put all your eggs in one basket. So don't just buy one stock or two stocks, buy a whole bunch of different stocks, and overall you're going to be winning. If one stock is not doing so well, you're going to compensate with all the other stock that you have in your basket. Although I don't really think, based on my research and based on even huge gurus like Warren Buffett, who doesn't really believe in having a huge portfolio of a whole bunch of different stocks and really just buying a handful of stocks that he truly believes in and truly thinks that these companies are going to grow over time. I'm sort of in the same way. I really think that you should really keep it as simple as possible and don't buy a whole bunch of different stocks that you don't know anything about. If you're only focusing on a handful of stocks that you really, really believe in, it's also a lot less work for you, because if you're buying a whole bunch of different stocks, well, guess what? In order for you to really do well, you're going to have to keep tabs on every single company and research every single company, and that's just not possible. You can't learn everything about a company and just do so much research about a whole bunch of different companies. You're going to know a little bit about each company, but you're not going to know enough in order to make a very good decision about where and how to invest your money and how much to invest. But if you're only focusing on a handful of different companies, there's only so much research that you need to do in order to really make a good educated decision about whether or not you're going to be investing in that stock. So diversifying is a good thing. Don't just invest all your money into one stock, but at the same time, don't try to buy a couple of little stocks of every single company out there, because that's just not going to be a very educated decision. All right, so once I decided which stocks that I want to buy and which companies I truly, truly believe in, the next step and the next question that I had myself, and I'm sure you do as well, is when should I buy these stocks, right? I mean, the whole point of the stock market is when to buy, when to sell. Now, first thing I want to tell you right off the bat, and that's something very, very controversial, but don't try to time the market. Nobody, and I repeat, nobody, not Warren Buffett, not just anybody out there that's doing stocks and even been doing stocks for years and years and years, nobody knows exactly how the market is going to react, what's going to happen in the market on a daily basis. Those people who we think sold and bought stocks at the right time don't have a crystal ball. Looking in retrospect, they might have made the good decision, but they didn't know that 100% going into and really buying the stock or selling the stock at a certain time, because they don't know exactly what's going to happen. Sometimes you sell the stock too early, sometimes you sell it too late, sometimes you buy it too late. You never know what's going to happen. But the one thing that I'm going to tell you, especially right now during this whole quarantine situation, during this whole COVID-19, is that start doing your research on a daily basis. I'm following the stock market pretty much every day and looking exactly what's going on, listening to as many podcasts and YouTube videos or in the news about the stock market to see what's going on and see what a lot of people say. And basically the way I do it is that I look at all these different opinions and I really decide what's going to work for me based on the decisions, based on the stocks that I think I want to buy. I'm looking at all the information available to me and I'm trying to make the most educated decision possible. What I recommend you do is instead, let's say you have $10,000 to spend in the stock market. Don't just put all that money at one time. So split up your investment and buy it as the stock is going down. You might not hit the absolute bottom because I said it's impossible to really time the market. But since you're going to be buying it at different points in time, so buy that stock today, buy a little bit of it today, then buy a little bit more next week, buy a little bit more 2 days from now, and buy a little bit more in 2 weeks. And chances are that's going to be a way that you're going to be actually capitalizing on your investment and really reducing your risk as much as possible. All right, so this brings us to the last point number 6, I think, of this whole video. And that's probably the most important thing that I've learned from my past week of investing in the stock market. So just like I mentioned before, whatever money that you decide to invest in the stock market today, if you want to make it another stream of income, what you want to do is invest long term. You're looking at all the historical data from the past, recessions and depressions. So if you're looking at the 2008 Great Recession or you're looking at the Great Depression in the 1930s, these times, just like today, were full of uncertainty. But over time, over a few years, 2, 3, 4, 5 years, the market recovered and the market continued going up. And the same thing is going to happen this time, but nobody knows exactly how long is it going to take this time. Is it going to take a year? Is it going to take a month? Is it going to take 2 years or 5 years? You don't know that. So what I recommend you do, and that's something super, super important, whatever money that you decide to invest in the stock market today, make sure that you don't need that money. You don't need that money today, you don't need that money tomorrow, or you don't even need that money next year. Because what you want to do is you want to invest long term. So you don't want to put money in today that you know that you're going to need next month in order to pay rent. Because if that's the case, not only are you going to be very, very stressed when that stock might fluctuate and go down a little bit, but you're also going to make very poor decisions when you decide to take that money out before you make any profit on it, or even worse, when you lost money on it. Stock market is really all about psychology and people's psychology, because the stock market does not go up and down exactly depending on what's going on in the market. The stock market fluctuates based on people's psychology and based on how people react to all these events. If people are feeling uncertain, if people are feeling scared, that's when people decide to sell their stock. And that's what really drives the stock market down. That's really what drives all the stock prices down as well. And when people are feeling hopeful, when people are feeling that everything is going great and everything is going to continue to go great, that's when people decide to double down, buy more stocks, and really just invest more of their money into these companies. So human psychology really plays a huge role when it comes to the stock market. And that's something you should really take into consideration. You should really think about not exactly what's going on, but how are people going to react to what's going on in the world. So I hope you guys enjoyed the video. If you did, give me a thumbs up, subscribe to my channel if you aren't already, and I'll see you guys in the next video. Until then, don't forget to stay unchained. Peace.